Let's say you want to get into the data center business. The pitch sounds incredibly appealing. You buy a large building, fill it with server racks, rent that space out to tech giants, and collect steady checks every month while you sleep. It's pitched as the ultimate passive income machine, a high-tech version of digital self-storage. In reality, these buildings operate as catastrophically expensive industrial power plants and massive cooling operations that just happen to house server racks. They are volatile, heavy-duty utility assets disguised as commercial warehouses. In normal commercial real estate, you price a building by the square foot. In this industry, you price it by the megawatt of power. And right now, building a modern facility costs anywhere from $10 to $20 million for a single megawatt of capacity. A modest 30-megawatt facility will cost you over $300 million before a single customer moves their servers in. We are currently living through a massive technological gold rush driven by artificial intelligence, meaning the demand for computing capacity is higher than ever. Yet independent operators with thriving, fully occupied buildings still routinely end up filing for bankruptcy. To survive as a digital landlord, and to understand why this asset class destroys so many outside investors, you have to navigate 3 specific, fatal traps hidden deep inside the data center lifecycle. The first trap snaps shut before you even pour a foundation. You can secure the perfect land and line up hundreds of millions in financing, but none of it matters if you cannot physically plug into the local power grid. Electrons, not concrete, are your true supply chain bottleneck. Take a look at Santa Clara, California. In 2019, a major operator finished constructing a massive 430,000 square foot data center. For years after completion, it sat completely empty. Not a single customer moved in. The local city-owned utility company lacked the capacity to turn on the electricity, leaving a finished, high-demand facility powerless and unusable. The building was a billion-dollar paperweight because the grid couldn't handle the promised megawatts. This specific kind of delay is lethal because of how these projects are financed. To build a facility of that scale, you take on massive debt, often $500 million. The moment you draw on that loan, interest ticks up monthly. The bank expects its cut, whether your utility is ready or not, bleeding millions against flatlined revenue. You can build the most efficient facility in the country and sign every tenant you want, but power access is the ultimate variable. It is the single existential risk that determines if you actually survive the construction phase. Let's say you secure the grid connection and finally open the doors. You immediately walk into the second trap. Even at full capacity, your operating margins are razor thin, leaving your entire business highly exposed to the structure of your debt. Cyxtera Technologies generated over $700 million in revenue in 2022, yet they were forced into Chapter 11 bankruptcy just a year later. Their business model relied on floating rate debt. When the Federal Reserve raised interest rates, their annual debt service costs doubled, instantly vaporizing their net margins. Beyond financial markets, your entire existence is governed by a terrifying legal contract called the Service Level Agreement. This mandates the 5 nines, a guarantee of 99.999% continuous uptime. To hit that metric, you have to build massive rooms filled with lead-acid battery backups to bridge the critical 15-second gap it takes for your fleet of diesel generators to fire up.
You literally have to keep tens of thousands of gallons of fuel on site, ready to run the facility off the grid for days. That extreme redundancy exists because the 5 nines legally allows your facility exactly 5 minutes and 15 seconds of downtime per year. A power failure lasting just 6 minutes triggers a breach of contract, forcing you to issue massive rent credits that wipe out your entire profit. A fully leased data center generating massive revenue is not a safe asset. A single decision at a Federal Reserve meeting or a fractional delay in a backup generator is all it takes to push a thriving facility straight into bankruptcy. If you survive the debt and maintain perfect uptime, you face the third and final trap: rapid physical obsolescence. A concrete building takes decades to pay off, but the technology inside it evolves exponentially, locking you into an endless, expensive war against thermal physics. SunGuard Availability Services was once an absolute titan of this industry, managing millions of square feet. They collapsed into bankruptcy twice because their massive buildings were physically optimized for the early 2000s. Their legacy infrastructure simply could not handle the power density required by modern servers. The AI revolution is now accelerating this obsolescence. A single modern server rack packed with specialized NVIDIA chips can draw 40 to 50 kilowatts of continuous power. That is almost a tenfold increase in concentrated heat compared to a standard rack from just 5 years ago. Traditional industrial air conditioning is physically useless against that kind of thermal load. You cannot blow cold air fast enough to keep these chips from melting themselves into slag. Operators are now forced to pipe pressurized liquid coolant directly into the server chassis. This creates the retrofit trap. Older buildings lack the vertical clearance for massive liquid cooling ducts, and their standard concrete floors will literally crack under the immense weight of these new high-density AI clusters. Independent operators are trapped on a relentless capital expenditure treadmill. You must continuously inject tens of millions of dollars into new cooling infrastructure just to keep the building relevant, rebuilding an asset that depreciates much faster than the mortgage used to finance it. The independent data center owner is fighting a brutal multi-front war. On one side, you have rigid municipal grid constraints and the unforgiving laws of thermodynamics. On the other side, you are competing against trillion-dollar tech monopolies who dictate the terms of the market. Those hyperscale giants, Amazon, Google, and Microsoft, have realized the public grid is too slow to support their AI ambitions, so they are bypassing it entirely. They are directly buying entire nuclear plants and operating behind the meter, securing their own massive private power supplies that independent landlords simply cannot match. Durable, monopoly-like income streams go to the operators, who secure ironclad utility grid contracts before they break ground, using fixed-rate debt to survive years of market volatility. These successful players treat the building as a secondary container for the true asset, a guaranteed power allocation. Ultimately, the concept of a weightless digital cloud is an incredibly effective marketing illusion. When you strip away the glowing neon stock photos, the data running our modern world doesn't float in the sky. It lives buried in wet, heavy concrete and steel, running inside the hottest, most financially punishing physical infrastructure ever built by human hands.